Hey, what's up, everybody? Welcome back to Pave the Way podcast. I'm your host, Greg Hellbeck, and today I am with a good buddy from Central Jersey, which was not too far from where I grew up. Now I'm in California. Steve Libman, who's going to talk about his journey on basically how he got into real estate, what he did the first really like 5 or 6 years of his career, and now what he's doing. He's doing some really cool things in commercial real estate. So, known Steve for a while. We've worked with him and his team in the past, and I figured he would be a great guest for anyone really, especially the ones who are, in residential, they're flipping properties, they're wholesaling, and they want to get into commercial real estate and they want to see if it's possible. Well, this is the guest to interview. So Steve, thank you so much for coming on the show today. I've been looking forward to this for a while.
Thanks, man. I appreciate you having me. Sorry I missed you out in San Diego, but glad we got to reconnect.
Hey, it's all good, man. I feel like nowadays with the internet, it's almost like, you don't even need to live anywhere near these people. As long as you have them on Zoom, it's the same thing. So before we kind of get into the nuts and bolts of today's show, I mean, can you just kind of give everyone a little bit about your background and kind of what you did before you got into real estate in general?
Sure. So I graduated from Boston University with a degree in sociology in 2004.
Okay.
And why'd you go into sociology? I always thought a liberal arts education was a good idea. It was well-rounded. And I always knew that I'd be in sales in some capacity. And I figured studying how people interact was probably a good way to have a good understanding of sales.
Totally.
And so I graduated in 2004. I moved back home to New Jersey, started commuting into the city and started working for a payroll tax filing service in New York City. I was actually just with a guy that I started my sales career with yesterday. He's actually interviewing now to potentially come on board, and we worked together back in 2004.
Wow.
And he's crushing it in sales, and we were just having the conversation about riding the elevator. Our first week of training was on a 38-story building. We had to stay in the elevator for 6 hours out of the day and strike up a conversation with everybody that came on and get them to give us some bit of personal information. So we cut our teeth the hard way, door-to-door sales in Manhattan. After doing that for a little while, I just couldn't stand being on a bus for basically the month of February. So I figured I could find something better to do at my time, moved home, tried a couple other different jobs. I sold ATMs for a while for corporate, and then I got into real estate. So I got my real estate license because my sister-in-law was opening up a real estate firm, and did that for 3 years, got my broker's license, was running that office, and she was listing a lot of bank-owned properties during the downturn.
Interesting.
And I was selling those bank-owned properties that she had the listings from direct from the banks to investors. So I was basically building my stable of cash buyers while being a realtor. And I just liked that side of the business a lot better than listing and going out on appointments and showing people 1,000 houses. Investors just want to know the numbers. So I could figure out what the ARV was. I could figure out within reason early on in my career what the repair costs would be and then what we could sell it for. So just building those cash buyers up front and then just reaching out to them saying, hey, I got this deal. It's coming on tomorrow. This is the price. Do you want to go see it today? And, so we were successful at selling a lot of those deals in-house by doing that. Because I did that, I was walking around with these guys looking at repair costs, figuring out how they were analyzing deals, and it didn't seem like rocket science. So I figured, I think I could do this. So really grateful to a lot of the investors early on in our career that encouraged us to go out and flip and wholesale and do those things. Most grateful for the guy who, after I made him 7 figures in 1 year by giving him some great deals, held my commission hostage for a $200 pool cover that he wanted me to pay for at closing. And I came home from that closing after relinquishing that $200, and I said to my wife, you know what? I'm done working for other people. And
love it, man.
Great catalyst to propel us into our wholesale and flip business. And that's where we got started.
Man, I did not know you were in the brokerage world before you got into the wholesale flipping game. I did not know that. I knew you were in sales for some time, but man, that Manhattan commute is something I mean, I know a lot of, I'm from, about an hour and a half from where you are right now. And that commute is rough for a lot of people. I know a lot of people my age now, I'm 24. So everyone really is kind of, they graduated college, they're going to commute to those jobs, and there's nothing wrong with that if that's what they want to do. But man, it's a freaking grind, especially in the grind. New York City. Man.
I sat down next to some guys who were doing it for 40 years.
Oh,
I did it for a year and a half and I was out. So God bless you if you do that. It was not for me.
absolutely, brother. Absolutely. I drove to Manhattan a couple months ago to smoke a cigar for a couple hours, and I couldn't even commute once. I'm like, this sucks. I want to get out of here.
Right.
Hell out of it. It was like a Saturday afternoon, you know? So, anyway, so let's kind of transition into like really phase one in your real estate career. So obviously you started out in sales, you were in the brokerage business. So, you know, obviously we kind of know why you wanted to get into flipping and wholesaling and more entrepreneurial, bigger profits. So, you know, how did you kind of go about building that business up? Because I know you guys really started, you were doing pretty good. And then you really, you know, tweaked a couple things. I think you joined a group and all of a sudden you guys just took off like rocket fire. Then you hired, or like rocket fuel, and you hired John and I to help you with your sales because you guys had so many damn appointments going on. So just kind of tell us a little overview on that and where you kind of built that business to, because it's very impressive, especially in, you know, a competitive market like, you know, Central Jersey.
Yeah. So we did in 2016 about 16 deals, and we were already in business for about 5 years. So Hurricane Sandy came in 2012. That put our business on pause for a little bit. We did kind of whatever we needed to pay the bills, right? We were doing some construction, we were doing some clean outs of houses and whatever it took, just to not go back and get another job.
Yeah.
The market came back after Sandy, and we started it created some opportunity for us to flip some lots, do some subdivisions, things like that. And then we were back in. But we were on an island. We worked really just by ourselves. We weren't listening to podcasts. We weren't around other people that were doing a lot of deal flow. So we literally jumped and grew wings on the way down. We just didn't know what we didn't know. Yeah. And Travis was listening to a podcast. Justin Williams at the time was doing the what was it, flip hacking or
HQ or whatever.
Yeah, flip it, right.
Yeah, that's a good show. Yeah.
And we learned a ton from that. And Travis on his third trip to Home Depot one day was like, I don't understand how these guys are doing 100 deals. We're doing 4 right now, and I want to rip my hair out. So we called Justin. We joined his we joined House Flipping HQ. We watched some videos over a weekend and saw that these guys were doing high level business, 100+ deals a year. We said, we need to get around these people because they obviously know something that we don't. And 2016, did 16 deals for about $250,000. The next year, we joined the group, and over the next 12 months, we did $1 million and almost doubled that revenue again the year after. So we just found the blueprint that other people were using, and we implemented it immediately, right? We just believe people when they say that they're doing things well, and we said, here's the blueprint. We can do that. It's not reinventing the wheel. And I think it just took us a long time to recognize that we needed to get around people that could show us the blueprint, that were already doing it better than we were.
Yeah, right. What do they say? Good artists copy, great artists steal, or whatever that quote is, or whatever. I throw that around maybe after a couple of years. Anyway, so I mean, before we kind of transition into kind of why you decided to start to leave that business in terms of high volume, what do you think it was? I mean, if there's a lot of residential investors, you know, listening to this right now, like what were those couple things that you saw those other investors doing that were doing high volume? It doesn't have to be everything you've learned, but like, what are a couple things that you saw that the other successful 100+ a year investors doing that maybe you guys weren't doing? And then what did you guys kind of implement that really started to really allow you guys to do more volume and have more of a system, it seems like?
So first it was hiring a team. We were trying to do everything on our own, and you can't. So it was hiring the team, and then it was spending consistent marketing dollars. Right. Okay. You know, we were trying to do some deals on MLS, trying to do some deals by bandit signs, some deals by door knocking. We didn't really have any consistent systems and processes. So once we figured out that, hey, if we're going to spend X amount of dollars a month, then let's just do it in one consistent marketing channel and then keep hitting the same people. And, you know, it was really a lesson in marketing. And that started getting consistent leads coming in. And then we needed to hire somebody to answer the phones full time. And then we needed to hire somebody to go on those appointments full time. So it kind of grew a little bit out of control in the beginning, to be honest. It was like, we were just trying to, you know, patch everything together and make it work. We, at one point, had 20 appointments a week. I mean, the phone was ringing off the hook. We had multiple lead managers, and, you know, it was just blowing up. So we needed to play a little bit of defense and figure out how to get that on track. And then hiring people, right? Hiring people was something that was foreign to us. And I think it's different. I think the biggest hurdle in this business is coming from the entrepreneur perspective to a business owner leader perspective. It's difficult to make that transition because as a born entrepreneur, you want to do everything yourself, and you can't if you really want to grow. So that was the catalyst. I think those two things: systems, processes, and hiring.
Yeah, no, that's it's tough to do, especially like you said. I think you got started, you were, I think when you kind of go from having a job to being an entrepreneur and you make money by yourself without like having someone pay you a wage or a salary, it's like you get into that hustle mode and you're like, man, I can freaking buy and sell. And next thing you know, you're, making money on your own. You're not quote unquote working for it. And then you get pretty good at those things. And then you're like, I don't want to have someone else do it. Like I have an assistant who works for me. That's it. And like, I remember I was like terrified to like teach her all the systems that I do. And now she does them better than me because I probably won't do them half the time. She'll do them, 75%, efficiently or effectively. And that's better than me doing it, 50% because I'm not doing it half the time. So,
and she owns it, right? So Jocko Willing talks about 75% of somebody else doing it is better than you even doing it 100% because you don't have to touch it.
It's her lane. Exactly. I just go in and tweak it when I see mistakes or whatever. So obviously you guys built this thing up and really, I've known you for a while, and I knew that I think you were always kind of, mentioning multifamily and commercial and stuff like that. What was the reason, obviously for the listeners, Steve's really now pivoted from really doing full-time single family fix and flip wholesales to now he's really getting heavy into the commercial real estate stuff. And we're going to get into that in a minute. But what was kind of the reason you started to get that seed in your mind and you were like, this is good. We're making money. We have a successful business, but why did you start to really gravitate, maybe away from the wholesale transactional business into this commercial industry? Because it's a lot of this situation is so common. And a lot of people that I talk to are like, oh, I want to get into apartment buildings. I want to get into doing real retail centers, but I don't know how to do it. And I'm wholesaling, and you kind of get like comfortable and stuck doing that, So what made you guys like take action on that? Like you guys drew the line in the sand. Like, no, we're freaking doing this. Like, we're not going to, wholesale for another 10 years.
Yeah. So we got into this business, as I think most people do, for financial freedom.
Yeah.
And after we've been flipping for 10 years now, and there was no light at the end of the tunnel. We got into this mastermind group. We built a good business. It was solid. It was printing money, and it limited our day-to-day involvement to a point, but it still has huge gaps, right? If you lose an acquisition manager and you have to jump back into acquisitions, or you lose this person, or marketing doesn't hit, like you're just constantly playing with the business to make it continue to work. And it's a great earned income job, but it's not passive, right? You keep saying the word transaction. It's a very active business. So
very active, tax-wise too. I just on the phone with my accountant.
Yeah. So those are the things that really was the catalyst for us. It was, okay, so I've worked myself into a very high paying, highly taxed job. Even though I own the company, it's still an active job. It's active earned income. And I pay 40 to 50% a year in taxes. So how do I get into a passive lifestyle that I get to keep my money? And commercial really is the only thing outside of oil and gas and the energy sector that does that in terms of the tax benefits. So commercial has some of the highest tax benefits of any asset class in the country. So I just wrote my last big IRS check because this year I have enough depreciation. Well, it'll offset it. It doesn't matter what I make. Yeah. I have depreciation this year where I won't pay taxes in 2019. So I get to earn less and keep more, but I'm earning more in this space. So really the catalyst was, how do I get to financial freedom? If I'm looking for this business to create a lifestyle for me and my family to where I get to go on vacations and I get to spend time with them and I get to not have to wake up and grind every single day, what business allows us to do that? And I'm really grateful for the wholesale and flip business. It got us around the people that we needed to get around, and it got us to the place that we needed to get to make that transition. But I always say it's like you can't unring that bell. When you look at the tangible tax benefits and the passivity and the economies of scale that come along with commercial real estate investing, it pales in comparison to the residential business. It's really like going from little league to major league. And I was just in San Diego with some of the best investors in the world talking in the residential space, talking about this. And I almost have to say it under my breath, but it's easier. It's a higher barrier to entry for sure. Like, you know, you can't just go buy a $15 million building if you've flipped a couple houses, right?
Yeah, that's a little different.
But if you can figure out some ways like we did through partnerships and through strategic alliances to clear those hurdles and clear that barrier to entry, once you get into it, you have just a very different way of doing business. Like, my tile guy doesn't show up on my residential job, right? We've never had that happen. The tile guy doesn't show up. I mean, we've all had to deal with these headaches that come along with the residential space. I have a closing today where the lender called me last night, and hard money lender, who said, "Oh, I can't close tomorrow. We're 2 weeks past the closing date already." So I fired them, and we're just going to close cash today. But it's super annoying. You went dark.
No, it's the office lights. Sorry. We're good.
So it's just these residential issues that pop up. They don't really happen in the commercial space. I mean, the guy who's building our storage facility right now in Orlando, he built the Orlando municipal complexes and their firehouses and the largest Porsche dealership in the country. This guy doesn't call in sick. His tile guy doesn't show up. He doesn't call me with the problem. He solves the problem. The economies of scale when you hire a contractor and give them $10 million is very different than making sure that your sheetrock guy is showing up.
Yeah, it's almost like comparing the major leagues to the minor leagues, man. Like it's everyone just seems like, and like I said, I'm not a commercial investor yet, but it's like, it just seems like that is everyone's like the promised land. It's like, that's where ultimately a lot of people want to get to. And it's funny, you shared all those things with, you know, the difference between residential and commercial. And it's like, I think Corey Peterson, you know, we both know him. He says that the juice is definitely worth the squeeze in commercial, opposed to, you know, there's just more to play with. There's more meat on the bone. There's just more everything. It's just, there's bigger deals and there's more opportunities to add value, which is ultimately going to lead to wealth. So no, it's interesting. And what did you have, like an event or a breaking point where you said, you know what, I've had it. I'm drawing my line in the sand. I'm freaking doing this. And then because like, it's a scary jump for residential investors, man. Like,
so no, to be honest, that wasn't the goal. The goal was to get the wholesale business humming, hire the chief operating officer to run that business, and then go off into the commercial space and build that out separately. But we lost an acquisition manager. So we were putting LOIs out. We were underwriting deals. We were looking at commercial deals. But we didn't get any like LOIs accepted because we didn't have the track record.
Yeah.
We weren't seeing real good deals because they didn't, you know, nobody cares that you're going to flip 175 houses this year. They want to know how many assets under management you have. So we weren't really seeing good deals, but we were working on this for a while, right? We were listening to podcasts. We were figuring out how to underwrite deals, but couldn't get any real deal flow. And then we had a deal. We partnered with somebody, we had a deal, and we needed to raise $4 million in like 6 weeks. At the same time, we had our acquisition manager quit on us. So now I have to do both things, right? I have to go out, raise money, and I have to go out and do acquisitions.
Yeah.
And we had some deals that were coming in closing that we were going to pay off a large amount of the investor money that we had in. So we could put that back out, or we were going to have to put it into marketing. So we had to take a 30,000 foot view and say, what problem do we want to solve? Do we want to solve the acquisition problem, which is going to take 3 to 6 months, right, to really cure and make sure that those people are running properly? And by the way, they might not work out.
Right. You never know, especially with salespeople.
Or do we focus on solving this $4 million raise problem so that we get involved in this $20 million project and we own a good percentage of it? And we just had to make a decision what we wanted to do. And a mentor of mine, Greg Dickerson, reached out and he said, look, you got to do what you want to be. And I said, well, what's that mean, Greg? And he said, don't do the things every day unless it's helping you be who you want to be and do what you want to do long term. So if you don't want to be a wholesaler, don't be a wholesaler. And it's so simple, right?
Yeah, right. I just wrote that down.
But at the same time, it's really impactful because what happens as entrepreneurs, I think we get pigeonholed into what's comfortable. All right. So it was really hard to leave my W-2 job and get involved in this, and build this up to where it's making me and my family pay the bills. And now I have to go and do this because that's what I really want to do. But it was harder to leave that and come to this than it was to even leave my W-2 job to become an entrepreneur, because there's so much more riding on it. And we said, look, we want to be this. So this is what we're going to focus on. And we ripped the Band-Aid off and we went out and we raised $4 million in 6 weeks and we got it done. And that was our first deal. It was an 1,193 unit self-storage complex down in Orlando. And now we just closed on our third one in Orlando. We've closed on a student housing complex with Corey Peterson. We're under contract on 66 units in Columbus, and we have an LOI getting accepted on 276 units in Columbus. So
love it, man. It's awesome. You guys are cranking, bro. Holy smokes.
So it's flying, but that was the big transition. Like, how do we make the jump and when do we do it? And we were kind of forced into the decision, and I'm glad that we were.
Man, that is impressive. And it's like you said, I mean, it's tough to do when you're, when you're quote unquote really, I wouldn't say comfortable, but comfortable. You're like, oh yeah, I flip. The marketing works, the business works, and then to do that, to really kind of follow, like, what do I really want to be? Like, I want to be a commercial investor in 5 years. I don't want to be flipping houses, and it's tough to do, man. So in terms of, and I respect that decision because it's certainly not easy. So what?
Yeah, shutting down. Somebody asked me, they're like, why would you shut down a 7-figure business? So I can build an 8-figure business.
So I can build an 8-figure business or 9. Yeah, exactly. Oh, I never thought of it that way. So let's get into this. So obviously commercial investing, that's a very broad kind of, statement there. It's a big niche, big industry. What are you guys buying in terms of, like, do you have certain, like, obviously you said self-storage, and are you just focusing on that in apartments? Or are you doing retail, office, industrial? Like, what are you guys kind of doing?
Nope. So we're anti-volatility. Part of our story is that, when my dad passed away 6 years ago, he lost about 40 to 50% of his wealth in the stock market. Oh, wow. And everybody did. It wasn't because of bad advisement or anything. It was just because the market tanked.
Yeah.
But then he passed away and he didn't get to ride the market back up.
Yeah.
So that made me really question, okay, so how volatile is the stock market? And then I was already flipping houses, so I understood real estate. So it was really, how do I focus on getting passive income and getting to retirement in a way that's more safe and secure and consistent? And, historically over the last 200 years, the volatility of the stock market is about 8 times what real estate is. And that's real estate in general. And then you go a little bit further and dig into real estate, residential versus commercial. And in the last downturn, the residential default rate was 4.5%. The multifamily default rate was 0.4%. The self-storage default rate was 0.04%.
Oh my gosh.
So it's really starting to have this understanding that all real estate is not created equal and that all investments are not created equal. So we focus on 3 asset classes, to get back to your question, is student housing, self-storage, and multifamily. So those 3 assets fared the best through the last downturn. Self-storage was actually the only asset class that actually increased in value through the downturn in 2008. It increased by 5% per year if you look at the data. And multifamily, we don't buy Class A high rises in San Diego. We buy Class B and C, B minus, C plus, meaning that blue collar workers that always need a place to live will have a good place to live. When the market is good, the people from the D assets move into the C assets. When the market's bad, the people from the B assets move into the C assets. But that asset class tends to stay full more than any other one. So that's what we focus on. So really what we're trying to do is preservation of capital, right? We want to deploy capital into these deals so we make a lot of money, but number one, we want to keep it. I don't want to see what happened to my dad happen to us in real estate. And you have to be really careful as to what you pick and choose to go into. Retail, I know if you look side by side, the returns on retail tend to be higher on a year by year basis, but the volatility scale is also there.
Yeah, the tenants and stuff. Yeah.
So if the market turns, the barbershop is one of the first things to close. The pizza place, even though there's always another pizza place behind you, they have a high turnover rate. So we stay away from industrial, we stay away from retail. We really just like to stay in the student space because, and specific in the student space too, right? You have to choose where you're going to invest in the student housing space and be very particular about that too, because a lot of the student space is moving to an online platform. So less kids are moving to college, except in, the Big Tens and, different schools like that. So, but government financing for students is not going away. Mom and dad are going to continue to pay the bills. We require 12-month leases with parental guarantees on all of our student housing complexes. So that really helps insulate that investment. And then the multifamily we just explained, self-storage, same thing. So those are really the three asset classes that we are particular towards and what we're going to stay in.
Interesting. No, that's really smart, because a lot of, the commercial investing in general can be overwhelming, but exactly kind of your three areas that you're going to focus on in that, in this obviously industry. And you obviously why it's important, right? Like, and I'm sure you can, I don't know enough, about commercial to be able to really continue this, but it seems like you said, the economy goes down, and, if you say you own an office building, your tenants they're going to default on their office lease before they default on their, apartment lease, because then they're going to be homeless,
Right.
So it's just kind of you got to pick and choose there. And, so are you guys, in terms of these deals, are you guys doing a syndicate? How are you raising the money? We'll talk about a little bit of raising the money, and then we'll start to wrap the show up. So how are you guys raising the capital for these deals? Are you doing all JVs, or are you doing syndicate? What are you guys doing just a high level in terms of raising capital? And how are you guys, earning income on these commercial properties? Because the way you earn money in commercials is a little different than, flipping a house.
Yeah. So we had investors that were investing into our fix and flips already. And we said, hey, look, we're getting towards the height of the market. We're going to start diversifying into what we consider a safer asset class. Would you like to come along for the ride? We're paying you very similar returns, plus you get the huge tax benefits that come along with commercial real estate. So, I mean, on average, we can do a cost segregation study on all of our projects. And basically that's just a fancy engineering report that shows you what you can accelerate the depreciation on a building. So in year one, we're writing off nearly 40% of the value of the building. So a $10 million project, we're writing off $4 million as a loss in year one, and passing that on to our investors and sharing in with us. That's why I said in 2019 we won't pay taxes, because we did 6 projects like that, totaling nearly $80 million. So if you write off, a quarter of that, you can see what we get to write off. Yeah. So we just said, hey, look, your money right now is in a vacant property, and we appreciate you living with us for the last 10 years and staying with us, but there's been some problems, right? We can't deploy your capital for 12 months out of the year. So if we're paying you 10% and we only deploy it for 10 months out of the year, you're getting 8.3%, not the 10 that we agreed on. So this will help keep your money deployed for 3 to 5 years at a clip, where you'll be making your money. We put our investors in a preferred return position, which means we don't make a dollar until they make their money back, plus the percentage that we've agreed on. So it really aligns our interests to make sure that we're good operators and we're making money past what the investors are getting. And so it's really friends and family. We have a large, warm network of people that we've grown to know over the last decade. And then we do partner with other people that want to join in on our deals and kind of learn from the inside and help us with the general partnership side, the investor relations, the project management, all of those different things that go along with it. And they can help us raise some capital. They can help us, do some things inside of the deal to where they can carve out some equity for themselves as well. So yeah, it's really just strategic partnerships, and then going out and telling the story, right? It's getting people to raise their hand and recognize that, hey, before 2012, you as an individual investor were not allowed to invest in these deals without going to Fidelity and investing in a REIT. So the Jobs Act made it legal that you could take your money and go put it with me if you wanted to. So it's educating people that they could, and then giving them the vehicle to do it. So without knowing us personally or another sponsor that's doing these deals, you really can't invest on your own. I mean, it's really impossible to go find a syndication without knowing the sponsor. So,
yeah, no, absolutely. And obviously you have to work with someone like you had the private money lenders on the fix and flips. And it's a pretty simple conversation. Like, hey, you want to basically the same return, essentially, that's going to be better with depreciation, or would you rather put your money in a vacant fix and flip? Because I do the same thing. I have private money.
And safer, right? I mean, 276 units, 2 people move out. Does it hurt your cash flow? Not really.
No, not at all. It's just
A lot of guys have these single family rentals all over New Jersey. And it's like when one person moves out, guess who's carrying the taxes, mortgage, and insurance? They are.
Yeah.
So again, economies of scale just insulate your investment way further than a single family residential does.
Absolutely. Well, I hope one of my private lenders is listening to this, because here's a quick story on that. So yesterday I get a telephone call. Meanwhile, I'm in San Diego. All my business is on the East Coast. Hey, Greg, you're not going to believe this. I'm like, oh God. I thought, because we just put it on the market, and I'm like, oh, maybe we sold it right away. And he's like, there's 2 feet of water in the basement. And I'm like, oh no. And then we got it figured out. But in general, we have private money on that. We're going to sell the house. We're going to do fine. But they are vacant properties, and the private lender is really he probably, I think they understand residential. It's a little more easier to understand. So you have to probably explain them the commercial a little bit more just so they get it. But once they get it, I mean, how easy, when your investors understood what you're trying to do in commercial, once they the light bulb went off in their head, they were probably like, of course, it's a no-brainer. It's safer when you explain it,
Yeah, I mean, at the end of the day, your house with 2 feet of water in it, you bought it really well. So that's why the investor is secured.
Yeah, exactly.
Right? So you buy it well, so the investor is secured by the value of the property. But if the market starts to turn, you're going to start to chase that, and you can dump the property and get the investor their money back.
Oh, yeah.
Unlike residential, where your value is based on comps, in commercial, your value is based on cash flow. So when I look at the cash flow, we're going to make $1.1 million in net operating income on this storage facility. So once it's stabilized, it'll kick off over 7 figures. Our debt service will be about $500,000. So we have $600,000 a year in free cash flow that's coming in. The investor is pretty well secured, right? Because
those numbers are great.
Insane. So our security is based on something else versus what we traditionally understand to be the value of a property. So our values go up and down based on how well we operate, how we reduce expenses, increase net operating income, and then what the market bears in cap rate, not what comps are going for. So it's all based on cash flow, which we control much more than the market. I can control the cash flow inside of my own business way more than I can control what the value of my neighbor's house is going to be.
I couldn't agree with you more, man. Have you heard of the book, What Every Real Estate Investor Needs to Know About Cash Flow by Frank Gallinelli?
I have not.
Oh, it's a great commercial real estate book. I just read it a couple of weeks ago when I was in Houston. And he talks about that. He's like, when you're buying commercial, you're buying the income stream. You're not buying the rosy bushes. You're buying the income stream, right? So when you sell the building, you raise the income stream, the property's going to be worth more money. So it's people, I think, it's really, it's almost like you can control your destiny more. So,
and like I said before, and I hate to say it, it comes off as easier because it's, for me, much more logical, much more tangible, much less emotional than buying a house in a residential space. This is just numbers. Can you raise rents? Yes. Based on what metric? Can you decrease expenses? Yes. Based on what metric? Pretty simple.
Yeah, right. It's black and white. And it's a business. It's a business. Your investment property is bought and sold by investors. In residential, yeah, maybe they're a little bit more liquid on the short term because you can have a consumer buy it. But, dealing with residential, like you fix and flip, I fix and flip. Dude, dealing with freaking residential buyers is the worst. It is like pulling teeth, and it drives me nuts. I'm surprised I don't have gray hair yet, because it's like I'm on the phone all day with people. They can't get financing. Their realtors, a pain in my neck. And I'm just like, oh my God, you guys are just driving me nuts. So anyway, I digress, but it's a whole nother business. So Steve, I could talk to you about this for 4 hours straight. So we probably will do that next time we meet up. But in general, I mean, if you had to leave the listeners with any parting advice, maybe they're in the residential game right now. They want to pivot to commercial, or maybe they're a new investor and they want to jump in, and maybe they want to start to jump right into commercial and maybe learn from an operator like you or whatever. What would your kind of last kind of bit of wisdom for everyone listening be as we start to wind the show down?
So 2 things. 1, don't reinvent the wheel. Find people that are doing it, partner with those people, and just say, hey, how can I add value to your team so that I can get paid to learn? That's what we did. We brought money to a deal. Now we're in the deal. Now we're partners in the deal. We get paid to learn. So everybody, I think, has this mental block that they need to learn everything about commercial before they get into commercial. A lot of people have that mental block about residential too. I need to learn everything about this market before I go and make an offer. Yeah. Look, just do it, right? Find somebody that's doing it and say, hey, I want to be a part of the team on your next project, and here's how I think I can add value. And whether that's bringing money or bringing expertise or whatever the case may be, somebody reached out to me the other day, said, I can bring the grind. They're like, I will do anything you ask of me. And I said, well, I appreciate that. This isn't residential, though. There's not that much of a grind. So, yeah. I liked how he was thinking, right? He knew that he wanted to partner with us, and he was just trying to figure out how we could add value in the conversation. So yeah, don't reinvent the wheel. Find a good partner that you can resonate with, and then you can start building your portfolio on the backs of somebody else. I don't know a single person that's in this space that has been really successful that just built $1 billion portfolio on their own. Every single person has to start somewhere. They have to start taking a smaller piece of equity to do some work, and then all of a sudden they build the portfolio. Now the next broker that they call, they say, oh yeah, I built this. And they're going, oh, now I have credibility. Right. So that's how you cut the line. Don't wait forever and then say, I need to learn all this stuff before I get to jump the line. And then 2, if you are raising capital into these deals, make sure you raise the right capital. You can go to all of these multifamily events, and all of these guys, for whatever reason, like to teach the private equity structure from Wall Street, where you're getting a preferred return and then a 70-30 split to the investor, and the sponsor who found the deal is only getting left with, somewhere between 10 and 20% of the total deal, but it's your deal. And that's pretty normal on Wall Street. If Blackstone is going to fund you, that's how it looks. And a lot of guys have built $1 billion portfolios like that, but it's on the backs of institutional investors that have that model. And now these gurus from the stage are teaching everybody else to raise private capital that way. For me, I know that my investors have been investing with me for years because they want safe, secure, consistent returns, right? So we offer them that, and we don't need to train the capital to do what Wall Street does because they're not as sophisticated as Wall Street. Find out what your investor wants, find out what kind of returns, right? When you started raising private capital, you didn't come in and go, hey, by the way, I'm going to give you 12%, right? You said, what are you making in the market now? What would you be happy with if you were to lend on a vacant property for me, right? Most of those guys were saying, oh, I'm making 5 in the market. I would be thrilled with 8. You got 8% money and they're happy, you're happy. So
now you're good to go. Yeah.
Don't train your capital based on what other people are telling you to do. Corey Peterson talks about this a lot. We talked about it on his podcast. Just make sure that you are giving the investor what they want, because at the end of the day, the only metric that matters is, do you have happy investors?
No, that's gold. That's absolute gold advice. He was actually, I saw Corey, I was chatting with him a couple of weeks ago at an event in Texas, and he did a whole presentation on this, how he raises money. And it's like, you got to find out what they want and give them what they want. You don't have to train them on, oh, well, the market's paying 15% to investors. It's like, no, what are you getting?
When you start telling people, I'm going to give you an 8 pref and a 70-30 split, but the hurdle rate, once we change,
they're gonna, yeah.
I get confused, man. And I have an education in this. So
yeah, same. Yeah,
hey, investor, I'm going to give you X. Is that good? Great.
Yeah. Less is more. Less is more. That's like the motto of my life. Simple, simple, simple. Well, Steve, if people wanted to get in touch with you, what would be the best 1 or 2 ways they could reach you and find out about what you got going on?
Yeah, so you can check out our portfolio and our investor portal at integrityhg.com. The name of the company is Integrity Holdings Group. We're on every social media page you can find. And then if you just want to hear some testimonials from some of our previous investors, you can go to freefromwallstreet.com. That's the same name of our podcast as well.
Awesome. Well, I'm sure people will be checking that out. Steve, this has been a lot of fun. I'm looking forward to the next time we get to chat. And I hope you have a good rest of the day, my friend.
You too, brother. Thank you.